Despite the optimism over the jobs, there's been a recent pickup in layoffs across some tech companies. Hendrik Sabrandi has more.
By many measures, the U.S. economy has been on a roll. Inflation has come down dramatically. GDP growth is up. The unemployment rate has remained below 4% for the past 2 years. 2023 was a great year for American workers, says President Biden.
14 million new jobs since I became president.
2.7 million last year, surprising those who thought interest rate hikes from the Federal Reserve to tame inflation would put lots of folks out of work, like Stephen Weiler, professor of economics at Colorado State University.
We haven't seen it before. I mean, the economy continues to astonish. We are churning out new jobs.
And yet these headlines announce recent job cuts, including nearly 25,000 layoffs in the tech industry already in 2024 at companies like Google, Microsoft, TikTok, Amazon, and Meta. More than 250,000 jobs vanished in Silicon Valley last year. Elsewhere, UPS has announced plans to lay off 12,000 employees this year alone.
I think there was a big party then in the teens, and I think it's coming home to roost. Money was cheap. They invested heavily in people in particular,
especially during the pandemic.
A lot of these tech companies spend like 1980s rock stars the last few years, and post-COVID growth hangover, a recession on the doorstep, you're starting to see costs that need to be cut out of the businesses.
Some experts think there's a herding effect going on. They say tech giants are copying each other by cutting costs to drive up their stock prices and please investors.
And the small guys, it's tough out there. I mean, now it's gotten tough to get money. Venture capital is drying up.
The era of low interest rate easy money is over. Weiler says these days, tech executives are nimble and proactive in the way they run their businesses.
These are folks that know how to run these tech companies, and these tech companies are particular animals, and they are resilient.
It's all part, he says, of a dynamic economy. Job openings in the U.S. are at a 2-year low. Unemployment aid at a 2-year high.
The economy is constantly creating and destroying jobs.
No fun for those laid off, but new work for them may be just around the corner. Fingers crossed. Hendrik Sabrandi, CGTN, Denver.
For more on the jobs number, we're joined by Santosh Rao. He's the partner and head of research at Manhattan Venture Partners. Good to see you again. Thank you for joining us. I'm going to start with these jobs numbers. I'm going to imagine you're pretty pleased with them as well.
Absolutely. As surprised as all of you are. Just a blowout number, very good across the board, beat all expectations. So all that is great. But just one caveat, January numbers tend to be a little distorted. There's a lot of adjustments that need to happen. So we might see some correction in the next month. But overall, even if you consider that, the numbers were higher than expected. So that's good. That's very good in that sense. But on the other end, it has some ramifications in terms of the Fed thinking and how where the pace and the timing of the rate cuts and all that. So we can talk about that. But overall, in terms of just the job report, a good number across the board, surprising everybody.
We have had a tremendous last 12 months or so. We had rates spike all the way up to where they are today. It's historic. We haven't seen this in a very, very long time. You have 2 major military theaters going on around the world, possibly a third now. Yet the markets are at an all-time high. And this has to be surprising, whether you're a strategist or you're an economist. How is this economy this strong in spite of those challenges that we've talked about for the past number of quarters?
Absolutely. I think you touched on a very important point. There's been a big disconnect between what the experts and the economists and everyone's been predicting and what the real economy is doing. And there was supposed to be a recession last year, then mid-year, then the end of the year. So the timeline's getting pushed out more and more because everyone's been wrong. And there are a lot of things going on. The productivity has gone up. The companies are functioning differently, and there's been a rolling recession of sorts. Different industries got hit at different times, so we haven't seen a full impact at once. So I think that's going on as well. But overall, I think things are. It is a little surprising how things are going. This geopolitical tension adds another layer of another factor in this whole calculation for the Fed, and they were right in saying that March is off the table in terms of raising rates. They were worried about inflation coming back with this geopolitical cross currents, and the supply chains may get disrupted again. I think the Fed is going to hold off. They don't want to get ahead of this. They want to wait and see when to do it, because all these job reports and all the wage increases are inflationary, and they don't want that. So all that is going to happen. So they're going to hold off on that.
You got the wage increase. You say they're going to hold off. I think the odds of them raising rates are around 30 to 35% at this point, so maybe it's off according to you. But here's a crazy question. Does anybody care what the Fed does anymore? Because it feels like the market doesn't care.
No, the market does care. I think at some point it is going to bite. If the rates are longer for too long, it's going to slow down things, and that's what they want. The capex is going to go down. Companies are going to be uncertain. The IPO market and all that is also waiting for the interest rate regime to settle down. So it has ripple effects if the Fed remains higher for longer, for too long. So I think that's the big risk on the other side. If they stay longer for too long, you're going to have disinflation and all that stuff. So we want them to really get the right balance, and that's going to take some effort with all this geopolitical tensions going on. And the companies, even though they're laying off, on the other side, the employees are finding jobs at maybe smaller firms. So net, it hasn't been that bad in the tech sector. Yes, there have been layoffs in other areas, but they were overhired in the pandemic area. So there's some adjustment, rationalization still going on. So all that is playing out. So net, it hasn't been that bad. Hopefully, if things turn out better down the road and there's no major disruption, we might be able to ride out with a soft landing and a very mild recession.
In what scenario would the Fed say, you know what, markets, you guys are right, maybe we should cut rates, but I find that hard to believe. We have some 9 million job openings today in the United States that are currently unfilled. There are shortages in hospitality, there are shortages in services, the list goes on. Wage growth, we already saw that, and the reason why there is going to be probably more wage growth because there's still an imbalance of people who are looking for work and the jobs that are available. Why would the Fed want to cut rates anytime soon, albeit a disaster?
Yeah, I mean, see, the real interest rates are getting very high now. If the inflation keeps coming down, which was the original idea, and the prime rate is still, Fed rate is still at 5.25. I mean, the real rates are going to bite at some point. It's not going to be very constructive for the economy. So I think that's one point where the Fed might say, you know what, we need to come down a little bit. But if inflation now keeps going up, they're not going to cut rates at this point. They want things to slow down. They want to lighten up the things. And that's the main thing. And the goods inflation is pretty much coming down. The services inflation, which is not very interest rate sensitive, I mean, you're still going to take that vacation regardless of the interest rate, all those things. You're still going to get a haircut, all those things. The services sector is not very prone to interest rate hikes and all. So that things needs to slow down, and that's a function of the job market, that's a function of money in the pockets, things like that. So that needs to slow down, and so they're going to do whatever it takes to kind of get the economy down, to take some heat out of the economy. So that's what's going to cause them to stay there for longer, till the sentiment is there that things are getting tough and people cut back on a lot of spending. So that's the main thing. At that point, they will, when things slow down that much, they will start cutting rates.
Santosh, we will see if people will cancel their vacations. For now, they are still spending. We shall see. Thank you for helping us understand this complex topic. Santosh, partner and head of research at Manhattan Venture Partners. Thank you.